We started chapter 23 last time, and we are in the middle of this chapter, and now we're going to continue on the latter part of this chapter, just continuing the topic on budgeting. We're going into more details on understanding the variances between master budget, flexible budget, and also between flexible budget and actual results. Okay, so today we're continuing on the topic on understanding the variances, whether it comes from price differences or whether it comes from material-wise, how do we use it, or labor-wise, the hours, whether it's the same as what we expected. All right, so last time, I'm just going to do a brief recap, and we're going to do a few more exercise problems before we go into new materials. So last time we covered mainly this chart here, the differences between master budget and flexible budget, and also between actual results. So first of all, what is the main difference between these two? When we talk about master budget, we talk about flexible budget, what's the key point? That's the key differences. Has a range of specifically a range of different sales volumes, right? So meaning that in static budget last chapter when we talked about budgeting, we only set it at as a certain level. For example, we want to sell at least 8,000 units. So we set the sales outputs as 8,000, and then we calculate variable expenses based on 8,000 units, and then we also estimate fixed expenses based on 8,000 units. But when we talk about flexible budget here, again, we do this before actual results are out. What this is just expanding master budget. So basically, we're not just having 8,000, but also perhaps we want to budget also 10,000 units, or slightly lower, 6,000 units. So the range is dependent upon the company's expected sales volume, the range that they set it themselves. But basically, it's more than static budget. We will have a table, flexible budget table that has based on different sales level, but we still use the same variable price, for example, $8 per unit to calculate the total variable expenses. And then we still have the same fixed expenses. So basically the only difference between flexible budget and static budget is that we have additional sales volumes, but basically the variable cost slope is the same. We're not setting them as different. We're just assuming that based on static budget, just in case we had additional sales volumes, just in case we had lower than what we expected, what would be the actual output of variable expenses, fixed expenses, and what would be the operating income for these different situations. But then when we reach the end of the season, when we come to actual results, this is a time when we compare whether or not there's additional differences, not just because of sales outputs. So meaning that if at the end we actually did sell 8,000 units, but we realized that originally static budget tells us that 8,000 units at the end we probably will be able to get, let's say, $20,000 of operating income, assuming. So if this is the case, this was static budget, flexible budget for 8,000 units is also this column, but then actual results, we sold 8,000 units, at the end we only got 15,000 operating income. So this is the part where flexible budget will be useful for, because we select this part here, sales outputs as we budgeted, and then we use the $8 variable expense, $10,000 fixed expenses as we planned, but we want to compare whether the actual results, this part here, variable expense and fixed expenses, is really still $8, and whether fixed expenses is really still $10,000. Okay, so the differences between these two, we then further break it down into price variances, when we purchase the materials, when we set the labor hourly wages, whether it's still the price that we expected, or was it more than that or less than that. Efficiency variances, if we expected to use 1,000 pounds of certain materials, at the end, then we still use 1,000, or did every job, every product, we actually only used 800. It was more efficient than we expected. Okay, so this part here compares the materials, like the actual pounds, or the number of hours that we use, this part here compares the price-wise. So it could be the input of materials, each pound, how much did you spend on that, or hourly rate of wages. If you expected to spend $10 each hour for each worker, at the end, did you actually spend $10, or did you spend more than that or less than that? So that would be price variance part. This part would be comparing pounds or the number of hours that you expect to input to a certain job. Any variances there. Okay, so this first chart we showed in this chapter relates to showing basically the differences between flexible budget and actual results. Is what we call flexible budget variance. So you see that we set the DVD sets both at 10,000 sets, and we compare whether results are still different. If there are still differences there, then that means it's not because of sales volume, it's because of other areas of expenses. Okay, now the difference that we call sales volume variance, based on its name, basically is the differences between static budget and flexible budget, where we set the 8,000 DVD sets to sales volume was actually different from what exactly happened. Okay, so flexible budget is a range of static budget. At the end, when actual outputs are there, we select the column to compare against based on the actual DVD sets. And then sales volume difference is the difference between static budget and flexible budget, where there's only sales volume differences. Okay, thank you. All right, so we went over this example last class. We started from static budget. We assumed that we're going to sold out 8,000 units, and this will give us sales revenue $96,000, variable expenses at $8 per unit, and fixed expenses at $20,000. Actual results is here, and we notice the differences between operating income is $4,000, and since it's more than we expected, it's considered favorable. Okay, so we want to know whether or not these differences comes from sales volume or variable expenses or other expenses areas. We set flexible budget in the middle at the level of sales the same as actual outputs. Okay, so the middle part here, you see that 10,000 DVDs is the same as the actual results. We only select the column where it matches with the actual DVD sets. And then we see at the end, the results is still different from what we expected. So theoretically, this should happen if we sold 10,000 DVD sets based on $8 of variable expenses. But there are differences between flexible and actual. So to be more specific, sales volume, we sold out 1,000 more than we expected. Variable expenses, 6,000 more. And we also had a favorable fixed expenses that we spent 1,000 less than what we expected. Okay, so later on this chapter, based on these differences, we further break it down into price variances and efficiency variances. So this goes back to what we covered in the first three chapters. Remember the three categories of production cost: direct materials, direct labor, and also indirect material, indirect labor, and manufacturing overhead. Okay, so we'll be going into price variances and efficiency variances in those three categories to see specifically whether we use more materials or whether we use more labor cost in certain projects or whether it's manufacturing overhead that was more than what we expected. Okay, so we only break down the flexible budget variance into these two parts and then specifically go into different categories of cost. So remember this first part here, direct materials variances. When we talk about price variances, assuming that each square foot we were able to purchase the materials at $2. That was our original plan. But later on, when we actually do the transaction, that was the budgeted numbers. When we actually do the purchase transaction, it only cost us $1.90. Okay, so meaning that for each square foot, we actually saved 10 cents, right? So use that 10 cents times the actual square feet of materials that you used. At the end, we had a favorable $1,200 because the actual money spent was less than what we budgeted. Now, if we take a look at materials efficiency, what that means over there is the actual quantity used for the job. We used 12,000 square feet of materials, and we expected to use only 10,000 square feet. Okay, so meaning we actually used more materials than we expected in each project. So there were 2,000 square feet more, and each square feet we paid, the standard price for that was $2. So price variances we captured in the upper equation there, materials price variance. The low part, when we calculate efficiency variance, we only use the standard price, the budgeted number, $2. Okay, so the efficiency variance is here. Since we use more materials than we expected, this is considered unfavorable to the company because they spent more. There's more cost on using the materials. Right, so if we combine these two effects, we had price variance is favorable. We spend less on each square feet when we purchase it from our supplier. But later on, we contributed to more. The more materials contributed to those projects. So overall, the effect is still unfavorable. 2,800. Favorable, unfavorable. So meaning that if we actually spend more than what we budgeted, AQ is more than, or AP is more than SP, then that's unfavorable. If we spent less, then it's favorable. Right, so this was materials. Labor, the same idea. Labor price variance, if hourly wages originally we set it as $10.50, but then when transactions actually occurred, we actually paid out $11 to the laborers. Each hour, we're losing 50 cents compared to what we budgeted. We spend more, so it's unfavorable. Okay, labor efficiency, the number of hours that we expected workers to contribute to the job. If they spent less in the project, then it's considered favorable to us. Okay, so we budgeted 4,000 hours for workers to work on a certain production line. They only use 3,800 hours. So the difference is 200 hours is considered cost saving for the business, so it's favorable. Okay, so again, we combine these two, the total effect of flexible budget variance here for direct labor costs will be $200. That's considered cost saving to the business. It's favorable. All right, so this is a brief recap of what we covered last chapter. Today we'll be continuing on manufacturing overhead variances. It's pretty similar to direct materials and direct labor. It's a little bit different, but we're going to go into details later. Before doing that, let's do a few problems. I want to make sure we all know the concept here before we move on. All right, so take a minute to read this problem here. It's about a connectors production business, and they budgeted variable cost for each connector, $145 per connector. Fixed cost for the entire month is $7,500. Okay, now the static budget predicted that sales of there would be 100 connectors sold out, but actually they produced and sold only 84 connectors. Okay, now try to calculate the flexible budget cost here for 84 connectors. Not the variances, just the flexible budget cost, not the differences. So this problem here, the static budget here, originally they expect to sell and produce 100 connectors, and the variable cost for each connector is 145. Fixed cost is 7,500. Right now, the flexible budget here, remember the differences between this and static is that we set this as the actual outputs. Okay, so 84 connectors is the actual volume of sales and production, but for flexible budget, we still use the original variable expense that was set up in static budget. All right, we're not comparing with actual results, and the problem didn't tell us the actual variable cost spent either. Okay, so this part here we use budgeted and fixed cost $7,500. So you use 84 times 145 plus 7,500. Okay, remember here the question is asking you the flexible budget part, which means theoretically you should be able to calculate this before actual results are out. Okay, but we will select the column where the flexible budget is set as based on the actual outputs. So the entire table should be multiple columns with different levels of sales, but when actual outputs is out, we only select the column with the actual sales or the actual products that are produced. Okay, so 84 connectors times variable expenses that was budgeted plus budgeted fixed expenses. All right, keep this number. We'll be using this for next problem here. Now, this problem asks you sales volume variances. So you have the flexible budget cost that you calculated earlier. What would be sales volume variance here? That would be D. So which is the part, how did you get that?
Well, I subtracted like the budgeted number of units, 100, minus the actual.
So that would be 16, right?
And multiplied by the variable cost plus the fixed.
Okay, so would this be favorable or unfavorable? Think again. Think again. So the static budget is 100 connectors, and we want to sell 100, but then we actually sold 84. But the calculation is exactly correct. The calculation part, you want to get 84 minus 100. So since here, we usually use the actual minus the budgeted, so you know that there's a minus sign here. Minus 16, you're missing 16. So then you know it would be unfavorable here. Okay, so it would be minus 16 times 145 plus 700. All right, so this should be unfavorable, $2,320. Here I highlighted this here because the book gave you the answer D, so make sure you go back to change the answer to C. Okay, in the textbook, this problem is from the book number 2 from this chapter. Make sure you change the answer to C. It's not D. It should be unfavorable. Okay, so the first problem we got flexible cost. Now we have sales volume variances. Of course, you can also get the entire static budget first, static budget and operating income, and then just subtract these two. That will be the same thing. Or get the differences here and then times 145 plus 7,500. Okay, so you probably can guess the next problem. That would be flexible budget variance. Okay, so now you have flexible cost, you have the static budget. What about flexible budget variance? So the company now, this problem here tells you additional information that the actual total cost, spent is $21,000. Okay, so what would be flexible budget variance here? So this problem here, do we have the actual variable expenses spent? No. Do we have the actual fixed cost? No. We only have the budgeted information, right? But what we do have is the total cost that we spent. And the previous problem, you already got the budgeted cost. So basically, it's just the differences between these two, right? Because you know it's 84 connectors, but you don't know the variable expenses portion, you don't know the actual fixed expenses portion. So this problem really is more elementary. It's just testing you whether you know what this term means. It's just the differences between these two numbers, but they're not going into detail on the specific area of differences. Okay, so just the total numbers differences. You got the 19,680 from the previous problem already, budgeted cost, the first problem. So flexible budget variance will be the difference between flexible budget and the actual results, the total cost. Okay, so just use 21,000 minus what you got in the first problem. And since the cost is more than what flexible budget shows, we're spending more in reality, so it's considered unfavorable. Okay, let's do a labor price variance problem. So it tells you that the standard cost of each hour, the hourly rate for wages should be $17. This is what they budgeted. And in reality, at the end, after producing 84 connectors, they spent for each hour $17.80 for the workers. Okay, so budgeted is 17. In reality, they spent $17.80. And they actually worked for 189 hours to get all the connectors out. Okay, so what would be the labor price variance cost here? Would be, you got A from how? You tell me what's the process here. That should be 80 cents, right? And then multiply by, should be the hours that they worked on the products. Right, because for the hourly rates, because the wages is based on the number of hours that the workers worked on. So if you are a part-time worker, you worked it for 10 hours, then our hourly wages rate, you're going to be paid for $17.80 times 10 hours, right? So here we use 189 hours because we're calculating labor cost. So labor cost is heavily based on the hours that the workers actually spend on certain projects or certain jobs. So we find the differences between the original budgeted wage and then also the actual wage that we paid out. So each hour we spend additional 80 cents, and then in total the workers worked in full 189 hours. So 189 times 80 cents, that will give you an unfavorable cost since we spend more. Specifically only looking at the differences between wages rate. So if we look at another aspect, that would be the efficiency variances. We will be comparing the differences between the volume. Yes, so try to figure out this one here. Now you will have to consider connectors. Okay, this problem here, it tells you we budgeted 3 hours for each connector, and at the end, you know, the total hours spent for these workers was 189 hours to complete these 84 connectors, right? But if we had 84 and using the budgeted rate, 3 hours, what would be the budgeted hours supposedly for these 84 connectors? 252. So we see that in reality they only spend 189 hours. Using the original rate, they should have spent 252 hours. So it's actually considered favorable to the business because they were more efficient in producing these products. Right, so here are the differences. Now we know the hours differences. So you just use the actual hours minus the budgeted. And it's less, which means means it's more efficient because you spend less hours on computing, on actually producing the same level of products. And then use the number of hours times, again, the cost. So each hourly rate, the standard price was 17. Now again, we don't use the actual price because we readily captured price differences in price variance calculation. So here we're just capturing the efficiency part, the hours. So we use the original standard price. Okay, so there were 63 hours saving times $17. This is considered favorable. So the 189 was given to you, right? And then this part here, originally this is the standard hours. So from the problem it tells you that originally each connector they allow workers to use 3 hours to produce it, right? So this was the original rate and this was the actual outputs. So supposedly they could spend this many hours. Any questions so far? I spent some time on reviewing this stuff because manufacturing overhead costs is really similar to this. So I want to continue on the same theory, same logic here. So you can actually get that part quicker. Right, so we talked about direct materials, breaking it down to price variance, efficiency variance, direct labor, also break it down to price variance, efficiency variance. For manufacturing overhead, we first of all consider 2 categories. We will have variable manufacturing overhead and we will have fixed overhead. So can you think of some of the example of variable overhead? But first of all, what is overhead? All the indirect materials, indirect labor is considered manufacturing overhead, and basically the definition is that it's hard to trace these costs to specific product lines. So some of the machinery, if you use it for multiple CD products, for multiple DVD products, or if it's just a printing machine that prints the label, the depreciation on that machine, these costs, or maintaining that machine's usefulness on repair, maintenance, all these costs are considered manufacturing overhead. Remember, plant manager's salary is considered fixed overhead. So variable overhead are those that really is like indirect materials, indirect labor, that will still float along with the more productions, the more costs is occurred. Some of the fixed overhead is like straight line depreciation on machinery, plant manager, janitor's salary are considered, if it's based on contract, then it's considered a fixed overhead. So this is just refreshing a memory on what manufacturing overhead is. And when we consider variances, we break it down into 2 different categories of variances. We will consider variable overhead in one category and then fixed overhead in the other. So what this is showing here is just refreshing your memory on earlier when we determine unit cost of a certain product. If a certain product, let's say the cost at the end is $8 and you mark it up to sell customers, let's say $15. We determine this $8 based on how much direct materials is used, how much direct labor is used, and then overhead, we also have variable overhead, we have fixed overhead. Add them all together, that will determine the $8 unit cost. Okay? So this comes from earlier, of course, the whole package of direct materials, how much we purchased, and then divided by, let's say, 8,000 units that we produced. So we will have a unit cost for direct materials. We will have a unit cost for direct labor, unit cost for manufacturing overhead. So this is the unit cost that we budgeted for this particular example, that 8,000 DVDs, right? So we budgeted that the total variable overhead based on remember the indirect materials, indirect labor. Altogether, we assume that we'll be producing 8,000 DVD sets, and this is heavily, let's say this company is heavily related to their laborers. So they wanted to use the allocation base as labor hours rather than machine hours. So this is given to you in the problem. They use 3,200 labor hours as a base to consider all these 6,400 costs. Okay, so then each hour they will be assigning $2 as variable overhead to each hour of workers. Each hour of workers' work when they contributed to producing a certain product. Okay, so this is the sort of like the base rate, the standard rate for variable overhead, which earlier in the first 3 chapters, usually we just directly give it to you. Okay, now for a fixed overhead, we assume that there's $9,600, which again relates to plant manager's salary, janitor's salary, or straight line depreciation on machinery. And the company also decides to use the labor hours as the allocation base. Okay, so overall, the fixed cost here is $3 that for each and every hour's work that the employees did with this product line, they assign $2 as variable overhead, $3 as fixed overhead. Okay, I want to bring this up front because later on we'll be using these as a comparison base. So basically this is the standard price for variable overhead. This is the standard price for fixed overhead. So what are we doing here? We're comparing whether or not the actual overhead that was assigned to the jobs is the same as the $2 and $3 price-wise. Okay, efficiency, at the end we'll also be comparing how much overhead is actually contributed to the job. So this goes back to the original table that we were showing on the differences between materials and labor, and now we're moving on to variable overhead. So we see an unfavorable $1,000 here, and now we want to break it down into also price and efficiency. So how do we take care of price? It tells you that the actual cost that occurred for variable cost at the end, we totaled it up, it was $9,000. This is the actual. And what was the budgeted? 7,600, and that is based on matching up with, remember the actual outputs, I don't know if you still remember, it's 10,000 DVDs at the end for this problem in the chapter. So they budgeted 8,000 units originally as static. At the end, the actual is 10,000, and remember flexible budget, we match it up to 10,000 as well. So the original 8,000, we had 6,400 as static budget variable expense, but since we used flexible budget 10,000 outputs, based on that, each and every hour, altogether, the cost spent is 7,600, based on the actual outputs and the actual hours, which was 3,800 hours. The original static budget was 3,200 hours. Okay, so now we're comparing the actual cost. Supposedly it should be 7,600 based on this level of output, but we had 9,000 instead. Okay, so this total 9,000 minus 7,600 would be the price variances, and we spent more on variable overhead cost. Okay, now in terms of efficiency, again, we go back to the number of hours. Why are we going back to hours? Because this problem selected direct labor hours as allocation costs. So if the problem selects machine hours, so theoretically in reality there should be multiple allocation base. Remember ABC costing? Each category they should have one. So this is only one example. This example given in the chapter is actually more simple. They only selected one allocation base and asked you to do calculations. Okay, so we just compared the budget is 3,800 hours with the actual hours. The actual hours that we spent was 3,800 hours, and the total allowed hours is 4,000 hours. Okay, so efficiency, again, just like direct labors, we compared the actual hours, the budgeted hours. Here the actual hours they spent on producing 10,000 DVD sets was 3,800 hours, but they're actually allowed to use 4,000 hours. Each DVD sets should be about 0.4 hours. Okay, so we had a cost saving 200 hours, and then we times the standard price again. Originally what we had was $2. So this will give us 400. Consider favorable because we spend less hours on producing 10,000 DVDs. Okay, so first the price variances here, we had unfavorable part because the total spending here supposedly should have been 7,600, but we got 9,000. And efficiency here, comparing the hours, we have 400 favorable, so overall the unfavorable deducted to 1,000. Okay, so this all together is just a part of manufacturing overhead, the variable overhead part, which will float up and down based on the number of units. Right, now the other part here is the fixed overhead part. So again, just by its name, fixed overhead part, supposedly it should not change regardless of the outputs. Okay, fixed cost, remember, for all these different level of outputs, it's supposed to be the same level, unless in reality perhaps we might have purchased additional machinery that wasn't what we planned. If some of the machinery broke down, we sold it out to secondhand market, we purchased additional machinery, then this will obviously boost up the cost of fixed overhead, especially if it's straight line depreciation. Okay, so here we still see that there's a differences here, which means there's something that managers need to look into, why there was an increase in the actual outputs. So supposedly it should be 9,600 all throughout different units of outputs. It should be a standard cost. That doesn't change, but we see that there's 12,300 here. Okay, so this part here is a little bit different from all the prior categories. This $2,700 unfavorable cost differences, we consider them all together and we call it spending variances. Okay, so meaning that earlier what we have been doing is breaking down different costs into two different categories, and both of these are considered flexible budget variance, right? But now for the very last category here, make sure you understand that this 2,700 is already the total flexible budget variance for a fixed overhead. We call it spending variances. We don't further break that down into different categories. So what the spending variances means is, in reality, the differences between what we actually spent and with the flexible budget, 9,600. Okay. So what this 2,400 means, you can just understand it as using the standard cost that we used earlier times the total allowable hours. Remember, 4,000 hours was allowed for 10,000 DVD outputs. Supposedly, the cost could have been bumped into 12,000 units, $12,000 of cost. But because we consider this as fixed costs, it should have, theoretically, it should be 9,600 all throughout. Okay, the actual one, we spent 12,300. This is the spending variances. We call the actual and the flexible budget differences spending variances. What we call volume variance for fixed overhead here, we're just comparing the 9,600 against what could have happened if we used still the standard price for the fixed overhead, which is $3, times the 4,000 hours that workers could have been using. Okay, this part here, it may be a little bit tricky to understand, but basically first part, spending variance, is just the difference, the total sum amount between the actual and flexible. That would be spending variance. What volume variance is showing that if we use the standard price, the fixed price that we spread it to each and every hour, and use this, apply it to the possible hours that could have been spent by the workers, then altogether it's possible that we could have spent $12,000. Okay, but we budgeted for 9,600 in the beginning. We could have, that was for 8,000 units. But for 10,000 units, we could have been budgeting $12,000. So that difference is we call a volume variance. It's just because the 8,000 and 10,000 differences. And we have this variance showed here. Okay, probably you're all confused now. We're going to do an exercise on this later. Just remember that for the very last category, this is the only part that's considered flexible budget variance. Okay, this part we just call it volume variance. It's really not part of flexible budget variance. Okay, it's still part of volume.
As long as the spending variance is more than the volume, it's going to always be unfavorable.
As long as the spending is more than the flexible budget, then this part here, yes, is unfavorable. And then overall depends on this. Okay, when we talk about fixed overhead variance, whether it's still favorable or unfavorable, that depends on how much this is. So this part here assumes that if the workers actually worked in full 4,000 hours, then the fixed overhead cost could have been $12,000. The original static budget could have changed to $12,000. Okay, so this volume variance is favorable because the actual spending, the flexible budget, we set it as 9,600. So we had 2,400 favorable here. Added with the unfavorable, overall we have $300 still as unfavorable, but it was a lot less than this part here. Okay, let's work on an exercise a little bit later just to make sure that we're on the same page. This basically just shows where I got this 3 from. So I was just worried that if you don't know where that $3 is from, that was from the original standard price that we got earlier. Okay, let's try this example. Just pull everything together on variable cost. So it gives you the 4 lines information on static budget, variable overhead. We budgeted for $9,000 and we budgeted fixed overhead for $4,500. We used labor hours as a base, just like the example I went over earlier, but it's not 32, it's 1,800 hours. And the static budget glasses is 6,000 each. Okay, so we want to get variable overhead rate. You will need to know what is the budgeted overhead in total. Overhead rate is budgeted cost divided by budgeted allocation base. Okay, so before calculating variances, we will first need to know these two. We need to know what is the variable overhead rate, what is the fixed overhead rate, so we have a base to compare against. Right, so the budgeted variable overhead total cost is how much? So the budgeted total cost, static budget variable overhead cost was 9,000. We budgeted this. And then the basis direct labor hours, we expect to have 1,800 hours, right? So the variable overhead rate would be around $5, right? That would be the budgeted overhead rate for a variable cost. Now for a fixed cost, standard fixed cost, the same process. We have a fixed overhead, 4,500, and again, we're using the labor hours to allocate the cost, so each hour the rate would be $2.50. Okay, we'll be using this for variable overhead variances and also fixed overhead variances a little bit later. Now, if we want to compute this part, using this information, if you want to get variable expenses, variable overhead variances and fixed overhead variances, we're referring to this problem here. How would you be able to get that? Okay, the next question is variable variance and also fixed variance. Okay, using this same data, you have now the standard price here. We also have $2.50. If you're trying to calculate variable overhead variance, fixed overhead variance, referring to this, what would be the process? So if we want to get variable spending variances, we are comparing which two numbers here? We're comparing using 10,200, that's the actual cost, and we should compare that against what? Using the static $5 times the actual number of hours used, right? Which would be 1,380 hours. So this together is the what we're trying to compare against, the standard. What could have happened using $5, and we want to know whether we use more than that or less than that. Right, so spending variances, the total cost we actually paid out is $10,200. Then the actual cost that could have occurred for these hours would be using a variable rate $5. Okay, so if you use 1,380 times 5, this will give you 6,900, right? But we actually spent 10,200 compared to 6,900. We spent too much compared to the rate that we got earlier. Okay, so this should be unfavorable. So this is the spending variances. The 10,200 minus 6,900 will give you 3,300. So what about the other one, efficiency? For efficiency, we'll be comparing the actual hours used with the budgeted hours. So we already know the actual hours is 1,380 hours. The workers use this. What about the original budgeted hours? Meaning budgeted hours at the level of having 6,900 glasses. So how will we be able to know that? So this is the actual hours. What about budgeted hours at the level of 6,900 glasses? What we got earlier, the 1,800 hours, is based upon 6,000 glasses. But now we actually got the flexible budget should be adjusted to 6,900 glasses instead of the original 6,000. So the 6,900 glasses, based on the rate, each glass should have spent 0.3 hours on it. So there would be 6,900 times 0.3 will give us how much? $2,070 hours, right? 0.3 because earlier the problem tells us that we budgeted 1,800 hours for 6,000 glasses. So meaning the rate that you expect workers to produce one glass is at 0.3 hours, right? So that's like about 20 minutes you want the workers to get done one glasses. But now we use that same rate. We know the actual results we got, the actual 6,900 glasses. So using this rate here, supposedly you should allow workers to use 2,070 hours. But they only use 1,380 hours, so it's actually favorable, cost saving to the business. Because we had differences, 20,070 hours minus 1,380 hours. That would be 690 hours favorable. And this hours, we times the original rate again, $5. So we saved 3,450 efficiency-wise. Okay, the following two would be fixed cost differences. So fixed cost, remember we break that down to spending and to volume variances. Spending variances should be the easier one. It's basically actual cost that you spent, which is actual fixed overhead would be 2,830. That's the money that you actually spent. We want to compare this with the budgeted numbers, right? So we have the budgeted rate, and the original budgeted hours is how many hours? 1,800. So the actual cost minus 1,800 times the budgeted rate, 2.5, that should give you the answer for spending variances for fixed cost. Okay, so 1,800 times 2.5 will give you 4,500 here. you know that actually you spend less than what you budgeted. So spending variance is just the difference between actual and the budget numbers. So it's favorable, yes, we spend less. So this part here, the 1800, was based on basically the static budget part, 1800. Okay, so what's a little bit confusing here for the very last part, the last category, the volume variance. Well, volume variance is using budgeted fixed overhead, which you already got from here. Remember, budgeted was the static times the static standard price. But we minus the actual allowed hours. So remember where we got this 2,070 hours from? That was from, remember, the 6,900 classes that we got times the original allowed hours. So supposedly workers could have used this much hours. So this is the hour, in case this is the hours they used, and using the standard price, they should have spent the cost at $5,175. Okay, so this is the $2,070 times 2.5. This could be the possible cost that would occur. But based on the standard price, the budgeted fixed cost, we usually assume the fixed cost is the same across all different levels. Right, so volume variances is just another way to estimate cost, and we want to know that in case that they actually spend the most of it, this could have been the differences. We could have had additional $675 spent. Okay, but since we didn't actually reach this point, so this is actually considered favorable, 675. So these two together is the fixed variances part. Spending variances, volume variances based on potentially what could have been spent. Okay, so in summary, what we've done so far in this chapter was understanding, again, actual results, the differences between that and static budget. We used flexible budget in the middle, set it as the actual outputs to see what was theoretically the expenses and income. But if we do see the difference between these two, then that means it's more than sales volume, it's something else. We might have price variances, efficiency variances, and we break these differences into materials, labor, and manufacturing overhead. That's what we covered so far. Okay, so each part of the variance has price variance, efficiency variance. Labor has price variance, efficiency variance. Manufacturing overhead also has price variance and efficiency variance, and we break that down to variable manufacturing overhead and fixed manufacturing overhead. Okay, so there should be 6 types of variances in smaller categories that you should know. All those 6 actually belongs to, besides the very last one, the upper 5 belongs to flexible budget variance. The very last one here is still part of the volume part, this part. Okay, any questions? This part here, when it comes to next week and you do the homework problems, that will be easier for you to understand more when you go through, but make sure you go through the example in the chapter. Understand the differences between these different categories of variances. Okay, let's move on to the last part of the chapter. What we're doing here is to capture the variances in journal transactions. Okay, so journal transactions is back. Do you still remember some of them?
Yeah.
Can you tell me what is the first one? Without looking at the arrow one, could you tell me from the first line and the third line what that transaction is about? We see materials as the debit side, which means is purchasing. We have an increased level of materials, so we received materials. Asset increase, that's from acquisition transactions. Right, so remember the very last line, in case you forget what each journal entry is about, the very last line is basically explaining what the entry is. It's a memo, right? So it tells you to record purchase of direct materials. So we have increased materials we debited, credit side accounts payable. Usually large businesses will defer some of the payments to later. So what is the middle part here? So what we learn in this course is all about differences between budget and actual. This here is capturing the differences between budgeted and actual price of purchasing materials. Right, so you see that I highlighted in red this SP there, standard price, meaning originally the company was budgeting for $2. That's already captured in their budgeted statement. When it comes to actually purchasing the material, they notice that they only used $1.90. Right, so remember, transaction is only captured whenever it actually happens. As it happens, we record these transactions. So standard price is already captured somewhere a few months ago in the budgeted system. We want to show here that there are differences between what we originally planned and what actually happened. So what actually happened is $1.90 for each square feet of materials. So we used 12,000 square feet. So the actual amount we paid is only $22,800. But we budgeted earlier as $2. So we have differences here at, we call it direct material price variance. Okay, so what this is showing is that if the company is using standard costing system, they do budgeting. For most cases, large businesses, they do. Managers, when they look at these transactions, they can easily capture which are the ones that has variances in material category and labor category and other manufacturing overhead. Okay, so if there is no differences, then basically we don't have that middle part, direct materials price variance. But in case there is, then for the differences in total, 2,400 compared to 22,800, we actually spent more or less than what we expected. We spent less, right? The standard price is 24,000. We paid out 22,800. So you see that variance account, think of that as an expense account. So if we actually do have expense, we spent more than we budgeted, it will be on the debit side. In this case, we spend less than we expected, we consider this as a contra expense side. So we will be crediting it. So that 1,200 basically we didn't pay. Accounts payable is the actual money that we paid. Right? What it does, the price variances, is basically a contra expense. So whatever materials later on was used, the actual expense cost of goods sold will be less. We're still capturing the actual amount that we used. Okay, so again, the upper part, materials inventory, captures the original standard price. Accounts payable is really what we paid out, what's on the paper, on the confirmed receipt, right? So the differences here are called the direct materials price variance. Since it's less than what we expected, it's a contra expense concept here. We will record that 1,200 here. Okay, we will have a separate account for each and every one of them. I just put them all together because the direction is the same for each category. Opposite of expense. So expense is spending more. Whenever you record something here, you're giving money out to somebody. Contra expense, you had saving basically. Think of it as saving because we thought we were paying 24,000, but we didn't. So we want to capture that 1,200 as less than budget. Okay, so think of contra expense as less than budget. Positive thing, yes. Whenever you see these variance accounts as the credit side is a positive. Okay, so as opposed to that, what we see here, can you explain what this is? Second entry. First, we purchased material. What did we do second? We under budgeted, and what is this category specifically on? Using materials, right? So remember that earlier in the first 3 chapters, we purchased the materials, and then when we start using it, it turns into work in process. Labor also turns into work in process. Manufacturing overhead turns into work in process. So work in process will be debited whenever we start the production cycle. When we don't start it, we just purchase it, it's just the upper entry. Once we start producing it, using a portion, acquisition department sends over the materials to production department, then we start recording the price of that. Okay, so here we have 10,000 square feet as the standard quantity that was supposedly we will be using this. But in reality, the materials inventory that was sent over to the production department was 12,000 square feet. So that was actually more than what we expected. So we had an additional cost spending in terms of efficiency-wise, right? So we have an expense account debited, direct materials efficiency variance. So now we have two different accounts here. Material price variance is the first one, and then we have efficiency variance, the second one. So the second account would be debited for the differences, 4,000, which is additional spending. Then we budget it. All right, so what would be the third entry? We have all the material issues here. So the following slide will be on what? Labor, right? Materials, and then labor on wages. So again, wages, we just talked about price differences and efficiency differences. So the first transaction here on wages, is it favorable or unfavorable? The first one. So there is a favorable one, and is it the upper one or the low one? Lower one's favorable, contra expense, right? So upper one, what does it tell us? That we're paying more, and specifically each and every hour we paid 50 cents more, right? So we had wages payable is the actual number that we sent out as checks to workers, and the manufacturing wages was the standard price. Differences here, direct labor price variance, we spent additionally more each hour, 50 cents. Altogether, we had another account called direct labor price variance, and we need to debit that as $1,900. Okay, so again here, once the workers start working on the production line for certain products, we would need to assign that cost again to work in process category. Remember, this category, this account captures all the in production, in process costs. So this tells us what? It's favorable, and specifically how much in favor? 2,100, and that's because of the 200 hours cost saving, and each hour based on standard price, we saved $10.50. So altogether, we had 2,100 as favorable. So you have another account called direct labor efficiency variance. And this variance here is favorable at $2,100, so we would credit it. Okay, so don't forget, debit side is expense, is additional cost occurrence. Credit side is cost saving, contra expense account. So we have materials, we have labors, what else? Overhead. So overhead here is a little bit different because personally I think this sequence is actually a little messed up. But basically the first transaction here listed number 5 is the actual manufacturing cost that occurred, which usually we only know this, remember, at the end of the year. So usually we would do a predetermined rate, remember, based on last year's experience, and as job occurs, we assign a portion to the jobs, then later we adjust the account. Okay, so number 5, this entry here given to you in the textbook is recording the actual cost. So just make a note somewhere that this actual cost, you only know it at the end of the year. Okay? So this is not estimation, this is the actual cost. Right, so what is number 6? Number 6, work in process been debited, manufacturing overhead credited. That's actually as the jobs occur when we assign materials to work in process, we assign labor to work in process. This is assigning manufacturing overhead to work in process. Okay, so this standard hours, 4,000 hours times the standard price, this was the original budgeted part, 20,000. And the upper part is the actual cost that occurred when you know at year end. So what does it tell you altogether here? We actually cost more, 21,300, and we only assigned to production work in process 20,000. So we're missing 1,300 here, okay? And that 1,300 breaks down to what we just talked about, variable overhead, fixed overhead. Specifically, let me just jump to it. The very last transaction here captures that $1,300 differences. Okay, so that breaks down to these two charts that I just showed you earlier on standard spending variances for variable cost, efficiency variances, spending variance for fixed cost, volume variance for fixed overhead. So you see anything with a unfavorable is listed as what? As expense. Anything unfavorable is additional cost spending. Okay, so anything with a favorable here is listed on the credit side. And if you just add them up, you'll find the variances show between the actual and the part that we assigned. Basically, is the differences here. Okay, so you have materials differences, labor cost differences, manufacturing overhead actual and assigned, and these differences here is captured in the very last transaction, which we have to allocate that additional 1,300. So remember, that was because earlier we already assigned a portion, but in reality we paid a total 21,300, yes. So you can think of it as earlier we just allocated 20,000, we allocated two less. Seems like we were allocating an additional 1,300. So really this is like the adjusting part that you learned earlier. It's just we didn't break it down into details. Okay, so the middle part here, you should know this by now. This is just assigning the remaining work in process into the jobs. This is nothing new here. It's just what you completed, you send it to finished goods, and then when you sell it out, it becomes cost of goods sold. Okay, so really the focus is on the first 6 entry and the very last one here. Right? I just have one more slide to show. This is just the T accounts, which I briefly went over there. Okay. And this income statement is just putting together everything. We can go into more details, but I wouldn't focus too much on this, just to let you know where this really goes into. Okay, so this is the very last table. Don't panic too much on going over this. I wouldn't be testing you on doing this, but you have to know what this means. That basically just breaks down all the variances. Those variances, think of them as additional expenses. So you just summarize all the variances here. If it's additional cost, you put a minus bracket around it. If it's saving, you put a bracket around it. So it's actually cost saving. Otherwise, it's considered additional expenses.